One of the most successful entrepreneurs in America over the past 50 years is going public with his fourth and final prediction about a scenario he calls America's Nightmare Winter. You've probably never heard of Bill Bonner, but in addition to owning an interest in businesses all over the globe, he also owns more than 100,000 acres with massive properties in South America, Central America, the US, plus 3 large properties in Europe. Bonner says, we're about to enter a very strange period in America, which could result in the most difficult times we've seen in many, many years. Bonner has made 3 similar predictions in his 50-plus year career, and each one proved to be exactly right, although he was mocked each and every time. That is why I strongly encourage you to read about Bonner's fourth and final prediction, totally free today. It's all spelled out in a free report we've put together about America's Nightmare Winter scenario. Get the facts for yourself. Go to AmericanWarning2022.com to get your free copy of this report. Even if he's only partially right, it will dramatically affect you and your money. So again, www.AmericanWarning2022.com. Welcome to Making Money. This is Matt McCall. Thanks for joining me. It is November 29th, 2022, about to enter the last month of the year. We had a big show coming up. Some unrest going on in China over COVID, how that is affecting the markets, specifically technology stocks and the giant Apple. Also, oil this week hitting a new yearly low. What is driving that? What it means for stocks? And the 60-40 portfolio I've talked about in the past continues to be on pace for one of its worst years in the last century. What that means for investing today, and more importantly, what it means for the next couple years. All this and more coming up right now on Making Money. Once again, thanks for joining me. This is Matt McCall, and this is Making Money. It is the 29th of November, 2022. It is a Tuesday down here in South Florida. So again, we want to talk about the markets because we don't want to harp on the exact action every Tuesday and Thursday. That being said, the action as of late is something that's very important and something that we need to keep an eye on. But before we jump into the actual market and how stocks and bonds have been doing and where I think they're going to go in the future, I think it's important right now. There's a couple of headlines that have come across early this week. One being over the weekend, the protests in China against basically their zero COVID policy, shutting down more areas of Beijing. Obviously, it means people can't go to work. It means production is going to slow, stuck in their homes, whatever it might be. And people are now fed up with it. They are now protesting the streets. And that's something you don't see as often in China, due to the authoritative, measures that the government puts on its people. So seeing protests really is something that we're not used to seeing coming out of China. And that led to the Asian markets, specifically Hong Kong and China, getting hit opening up the week because of that. And again, this could hurt their production, thus leading to stocks going down. And, the bigger thing here, folks, really is the uncertainty that surrounds the COVID policy in China, because again, being somewhat of a very controlling government, that could lead to even stricter policies going forward, and that's all up to the leader over there. So we need to keep an eye on that. And again, the unknown is something that is really more concerning to me than the potential dip in production in the short term. So we need to keep an eye on that. And that has rolled over into our stock markets here at the beginning of the week. It's also rolled over specifically into the technology sector, especially Apple. There's been some analysts that came out early this week talking about Apple iPhone production could potentially fall 10%. It would fall 10% because a lot of the iPhone production, of course, takes place in China. And if you can't get into the factories or you can't get the chips needed for the phones, obviously, that's going to be less production. That makes perfect sense. So again, something we want to keep an eye on. I don't think it is the end of the world by any means, and I think it's probably short term. But again, that has been leading to Apple stock pulling back a little bit based off that news. Monday, it started off the morning down over 2%. We could see if we could bounce back from that, but it has had a direct impact on Apple and on the markets in general. So again, the spillover effect from China has been seen here. That same Chinese issue I'm talking about is weighing on the price of oil. Oil hit the lowest level since the beginning of this year on Monday morning. We had oil pulled down by more than about $2, down around $74 a barrel. Keep in mind, it was just triple digits not too long ago. So we're seeing oil fall because the synopsis here is that if China production slows down, less demand for oil and fossil fuels. And being the second largest economy in the world behind the United States, if demand for oil falls, obviously there is a big natural correlation to supply demand curve, which will lead to lower prices. So that's something that it might end up being really good in the long term because lower oil prices will help the consumer around the world, especially heading into the winter months here in the States and in Europe, that we are seeing potential energy crises in Western and Eastern Europe. So lower prices could end up being actually good for majority of the global economy. Not everybody's going to see it that way, but majority of the global economy. So again, this is something we keep an eye on. I don't know if it means the end of this oil rally, that we don't hit triple digits again. I still think there's a great chance we do in the future, only because the transition to clean energy is going to take longer than any of us expect, in my opinion, thus leading for the demand for fossil fuels being out longer than initially that we predicted for the transition into clean energy. What I find interesting, some optimism here, outside of the fact that oil could be good, dropping that for a lot of us, and that India, one of the largest economies, Southeast Asia, one of the largest countries in the world per population, their stock market, believe it or not, when it opened Monday, it rallied to a new all-time high. Their big index called the Sensex closed above the 62,500 level for the first time ever. And the Nifty 50, they call it, the smaller one, above 18,600 for the first time ever. So some really major moves in Indian stocks. And I will say there are two Indian stocks that trade here, both banks, that have actually held up really well. One symbol is IBN, India Bravo Nancy. And that stock is trading near an all-time high, doing very well. That's a way to gain some exposure to really the economy in India due to the fact that it's a bank. And obviously a lot of banks tend to move in lockstep with the growth of the economy. The other one is symbols HDB, another large bank that trades here on New York Stock Exchange as well as IBN. And again, not doing as well as the first stock I talked about. However, holding up really well and the chart looks good. Those are two ways. I'm not saying you run out and buy these two stocks. I'm not saying you run out and buy anything in India. Again, nothing here is a buy or sell recommendation. However, just to let you know, those are two of the largest holdings in most of the Indian ETFs that trade here in the States. Now, back to the States and give you a little idea of just what's going on here with the old 60-40 portfolio. And again, I talk about this a lot, but if you're not sure what that means, it means 60% allocation to stocks, typically tracked by the S&P 500, 40% allocation into bonds. And the 60-40 is not setting up to be one of the best years ever, actually setting up to be one of the worst years ever. It's currently down about 15% year to date. If we close down 15% year to date, this will be only the sixth time in the last about 100 years that we've seen a pullback of that magnitude. The good news is, if we take a look at those 5 prior years, 1931, 1937, 1941, 1946, so a lot of them are way back, and then 1974, which is similar to what we have now, high inflation. And you take a look at the return 3 months after the year ends. 3 months after, the average returns a negative 1.9%. Nothing to jump up and down about. The average 6 months return after the calendar year ends, which would be 2023 if we end there. Average gain in 6 months, 2.7%. But however, when we start looking at a little bit longer, 12 months to 2 years, the numbers get dramatically better. Looking out 12 months, the average gain is 15.6%. And 4 out of the 5 years, all except 1931, we saw higher prices. And then we look out 24 months, 2 years. Every single time the market was higher, and the average gain of 36.4%. And if we look at the year that's most closely tied to what we're seeing right now, that's 1974. To give you an idea what happened in 1974, after that year, that the 60-40 is down over 15%, 3 months later, we're up 22%. 6 months later, we're up 41.3%. 1 year later, up 37%, and 6 months later, up 68.6%. So it gives you an idea every time frame up big double digits, that typically after this type of situation, we could see a big stock market rally next year. And I think that's extremely possible. I think the odds of that happening are well above 50%, probably closer around 65%. And not just because of that situation. There's a lot of other bullish factors out there right now, folks. We have seasonality. Typically, the best 6 months of the year start November 1st, which obviously started a few weeks ago. We also have, after the midterm elections, stocks historically looking back 50 plus years do very good. We have valuations that have pulled back to levels that are well off the kind of super highs that we had post COVID rally. And then we have stock buybacks. So let's dive into these a little bit. So we look at stock buybacks. This is something that is often ignored and not looked at too much, but there's been a change recently in some of the tax laws for stock buybacks, which I believe will lead to potentially a big boost in stock buybacks uh, between now and the end of the year, and even looking out further. According to Goldman Sachs, 21% of all corporate buybacks or take place in November and December. We're in the midst of that right now. And what that means is there's each stock has shares outstanding. There's so many shares. There's not a limited amount. There's a fixed amount of shares. And when a company buys them back, they use their cash to buy those shares back. So it happens oftentimes when we see stock prices fall because a company's buying back their stock at a much lower price, a price that they believe is undervalued. And at the same time, you're having buyers come into the market. So more buyers than sellers. You're also seeing shares come out of the market. So as shares come out of the market, it makes those earnings more valuable because the earnings are based on the amount of shares. That's how you get earnings per share. But if there are less shares, earnings go up. So the counter argument is that it can help fabricate higher earnings. However, over time, stock buybacks tend to be very good for stocks. There is a group out there that believes stock buybacks are manipulative and it's kind of creative accounting, if you will, and it can hide real issues with a company. Sure, there are situations where that is the case, folks. That being said, a lot of times smart management groups at these firms will buy back stock again at prices that are lower, and actually is really good timing for the stock. So I don't see it being a negative right now, but I do see it as something that potentially could be a boost for stocks between now and the end of this year and heading into next year. Another thing to look at is, the Dow is price weighted, meaning if the share per price per share of a stock is higher, it's actually worth more as far as the amount that it moves the index. And the Dow is price weighted. So if you take a look at this year, the Dow is not down that much. It's down single digits. So it's the best performing of the top three indices. 7 of the top 10 highest priced stocks are actually up for the year. And that's why you've seen the Dow hold up much better. 3 of them are down, Microsoft, Visa, and Home Depot. And the ones that are up, Chevron, obviously energy doing very well. Within healthcare, holding up better. Merck, Amgen, United Health. Some of the industrials are holding up better. Caterpillar or Honeywell. So you see some of those hold up pretty well. Tech stocks, on the other hand, have been struggling, and that's why you're seeing it kind of pull down the Dow, and why the Dow is still in negative territory. But to compare the Dow down about 5.5%, 6% right now year to date versus the S&P down about 16, it was a big difference, about 3x that or so, give or take. So a lot of times we see these indices, but we have to dive into it. And I'm about to dive into it in a moment here because a couple of interesting stats I came across just this morning is that about 60 stocks in the S&P 500 are having their worst year ever. And these numbers go back to 1968. Keep in mind, not all stocks were trading in 1968. They weren't even created in 1968, and I weren't even created anytime near 1968. But about 11% of the index is having their worst year ever so far. And that tells you something, because even though the S&P is only down about 16%, you think, well, that's not even bear market territory. At the same time, about 1 in 10, give or take, stocks are having their worst year ever. So that, again, is why your portfolio looks like it does, and that's why it feels so bad. And again, with the 60-40 portfolio potentially having one of its top 5, top 6 worst years in a century, that's why it feels like it hurts so much. So it's a very, very odd market that we have this year. But, I was going through some of the names that are having its worst year ever. And there's some newer names like Meta, which is the old Facebook, but also companies like Stanley Black and Decker. Black and Decker, the handhold tools and stuff. VF Corp, which makes clothes. Having its worst year ever too. So it's really hitting, honestly, folks, a little bit of everything. And then as far as the 60/40 is concerned, if we flip over, look at the bonds, the U.S. investment grade corporate bonds are having their worst year ever, worse than the Great Depression as of right now. So again, you're getting hit at all angles. Gold's down, cryptos are down, obviously. Everything's getting hit. I mean, there's obviously are areas that you can find some safety, but there's a lot of areas that have really taking a hit so far this year. I talked about valuation as well, so I think we should talk about that real quick. If we take a look, fourth quarter estimates now for earnings for the S&P 500 now expected to be down about 0.4% versus the fourth quarter of last year. And a lot of this has to do with technology. Expect to be down about 7.8%. Communication services expect to be down about 21%. Even though if it does come in a decline 0.4, I'll tell you a lot of times these estimates end up being much lower than reality. So we may end up seeing positive. We won't know until late February, mid-March, or late January, mid-February. But if it doesn't come in a decline, it is still the first decline we would see in earnings year over year since the third quarter of 2020. But again, let's take a look at where valuations were at that time versus now. At that time, we had the S&P 500 PE ratio, price earnings ratio, around 26 times. And if we take and about 21 times the future. We look now, we have the S&P right about 17 or so, just above 17 times its 2023 estimates, and the long-term average is roughly on 17. So we're down about average. It's not like we're at levels that are completely depressed, but we're not at levels of valuation where I see much more downside. I always look at the pendulum. The pendulum could swing from very overbought to very oversold, very high valuations to very low valuations. So yes, that PE ratio could continue to move lower, meaning stocks come down, most likely to get to that level. But again, if you're just evaluating stocks right now, whether evaluating stocks in your portfolio or evaluating potentially buying stocks, we have stocks sitting at about average PE ratio. We have great seasonality. We have a huge potential boom of buybacks coming in. So we have a lot of positives, even though majority of the media are going to talk about the negatives out there. And, we're in the time of year right now that is consumer spending. So I'm going to talk about that here in a moment because that actually looks pretty damn good. But again, just to kind of show you the situation that we're in right now, I want to show you two charts. And the first one I want to show you here, this goes back, folks, to the late 1800s. And this is Alpine Macro who put this together. And you can see here, it puts the 2022 returns so far in the S&P 500 and the 10-year treasury, so in stocks and bonds, into historical perspective. And as you can see in the left here, these are the distribution of bond returns. Again, going back to the late 1800s. Look where we are, minus 15%. Never been down there before if we're in that level. Never been down there before. That's how much of an outlier this is. We flip over to the right side here, the S&P 500. Again, we're in the third quartile on the downside. Very, very rarely do we get down here. And this, again, folks, this is something that you look at this and you say, that's why things feel so bad. I get this. All that being said, these are times where that's when opportunity is created because you don't typically stay down there. You don't have that many outliers to that side. The pendulum, as I talk about, is swung this way. Could it continue to go a little bit higher? It can. I don't know that. Nobody knows that. I do know, looking out several years, that we're at a situation right now where there is clear opportunity. There is clear opportunity in the stock market and in the bond markets right now. I don't talk too much about the bond markets, but there's opportunity in both. And I talked about that 60/40 portfolio, how good it does going forward after years where it's down 15%, which we're on pace for. So we are at a situation that is very unique. There's one other chart I'm going to show you, and this is going back to 2000. So what this shows here is a correlation, a 6-month correlation between the S&P 500 and the U.S. Treasury 10-year. And as you can see, a majority of the time, the correlation is negative. And what that means is as stocks go up, bonds go down. As stocks go down, bonds typically go up. And that's why you have the old 60-40 do well, because it's a bit of a hedge. It lowers your risk. But look, on the right-hand side, we're now at nearly 0.3, or it's right around 0.3, I should say. The correlation's still low. However, it's the highest correlation we've seen between bonds and stocks this century, meaning the 21st century. So again, these are situations and these are strange freaking times. It really is. This is not the norm. So if you're sitting there thinking, well, this is the new normal, it could be, but the likelihood of that is extremely, extremely low. It's much more likely that we're having a stock market right now that is pricing in negativity on both the bond market and the stock market. We're in a weird situation where the economy is slowing down and rates are actually going up, not going down, similar to 1974, high inflation. We are honestly, folks, at a situation that we don't see very often. As a matter of fact, it's extremely rare. And because of this, again, I see opportunity. I'm not saying you run out and you put everything you have in the stock market today. It's not what I'm saying. What I'm saying is that there is opportunity here, and we need to keep that in line, or keep that in mind. Now, let's do a wrap real quick of what happened. Of course, happy belated Thanksgiving to everybody. I said that last show, but happy belated Thanksgiving. We had Black Friday, of course, the day after Thanksgiving. We have Cyber Monday and Monday. And consumers spent a record $9.12 billion on Black Friday, just online shopping. That's according to Adobe. And those online sales for the day after Thanksgiving, they were up 2.3% over last year. I'll tell you what was contributing big to it. And you may want to think about this if you're investing in retailers. Electronics, online sales of electronics were up 221%. Toys, obviously extremely popular all the time, they were up 285% over last year, online purchases. And exercise equipment up 218%. That trend continues, and I think that trend's not going to end anytime soon. Mobile orders, meaning that you made the order on your smartphone, came in as 48% of all orders were placed on the phone. Think about that. The iPhone didn't exist 20 years ago. Now 48% of all online orders are through the phone. That's a 44% increase over last year. Even Thanksgiving Day, where you're not supposed to be shopping, you should be spending time with friends and family. They came out and spent $5.29 billion on Thanksgiving Day, up nearly 3% over last year. And again, according to Adobe, big money. Cyber Monday numbers are not in yet, but they're expected to drive sales about $11.2 billion. And that'd be up over 5% over last year. So if we're going into a Great Depression, if we're going into a major recession, if the economy's falling apart, would we see sales like this? Maybe. I don't know. I don't see the correlation of people spending lots of money then going into a time where suddenly you have a depression. I just don't see that. I don't see the economy going into a very deep recession. I think we're in a recession now, because whether the numbers say it or not, it sure as hell feels like it. So it's more about what it feels like. And it feels like reality. It feels like you're in a recession. But I got to tell you, folks, again, I think I'm going to keep harping on this, but the thing is, it's opportunity out there right now. And I think it's very tough to ignore the opportunity that we've seen. And again, you can just go say you do 60-40. According to Vanguard, if we go all the way back to 1926 through the end of last year, that 60-40 portfolio has an annual return of 8.8%. So that means around every 8 years or so, you would double your money. And you compound that, and it takes off pretty quickly. So again, there is opportunity out there in so many different asset classes. And I don't want you to overlook that, because it's very tough to overlook the negativity that's out there. I mean, it's the 60-40 portfolio, if you look at the real return, if you put inflation into it, we're down over 23.5%. That hurts. It hurts big time. I feel it too. I'm in the market. I own real estate. You know, I see it. My business is tied to the economy and the stock market. I feel it too, folks. So I'm not trying to be dismissive here of how you feel. I get it. I've just been managing money and doing this stuff for over 2 decades that I realize the opportunities that are out there. And as hard as it is to lay your head at night and think about your portfolio, it sucks. There's no easy way around it. But if you think big picture and you think positive, there are opportunities, and you don't want to pass those up. So again, this is all about, for the 25th time during this show, opportunity, because I truly believe we have one of the greatest opportunities of this decade right now to buy into the future of innovation, the future of this country, the future of this world, honestly, getting better. And there's a lot of companies out there right now that are really great buys. There's a lot of good bonds that are buys. There's a lot of good metals that are buys. So again, don't overlook the opportunity that lies in front of you here today. So again, folks, thank you so much for watching. We're back Thursday with a great interview. One of my colleagues, a good friend of mine. We dive into the markets. It's a very, very interesting interview coming up, and that will be coming up for you on Thursday. But again, have a great day, and go out there and give somebody a hug, tell them you love them. Enjoy life. It goes by fast. So thank you so much, folks. Have a wonderful day. I'm Matt McCall, and that was Making Money.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.